So I think we may start. Thank you. Thank you so much for being here with us today. All the distinguished speakers and panelists of this lovely conference. It is great pleasure for me and honor to be here with you. And today we gathered in this lovely place to answer a question that lies as the heart of the future of digital finance, which is, can regulation really catch up to innovation in the crypto space? This is the question. And I hope that today we may give some kind of answers. Over the past decade, as you know, cryptos and blockchain-based technologies have grown from a niche concept into a global financial ecosystem with trillions of dollars in the market's capitalization. This rapid innovation, of course, and the challenges for the regulators, that's why we have today the chairman of the Capital Markets Commission, Vasiliki Lazarakou, with us, policymakers like Yannis Tournaras, the governor of Bank of Greece and one of the oldest and exceptional ECB members, and institutional investors raising questions on stability. This is the question about stability. And of course, investors' protection and the systematic risk. On the other hand, innovation is moving at a pace never seen before, so rapid. On the other hand, regulation must provide trust, resilience, and long-term sustainability. So the critical issue is whether regulation will always lag behind innovation or whether proactively forward-looking frameworks can really and actually enable healthy growth in all the economies, not only the European countries and economies around us. So today we are very fortunate to have with us distinguished leaders from academia, regulation, and the investment world to shed light on this vital issue. So let me begin by introducing Vasiliki Lazarakou, the chair of Hellenic Capital Market Commission. Vasiliki, thank you for being with us. We have Larissa Yarovaya, director of the Center for Digital Finance, University of Southampton, and the coordinator of this great conference on cryptos research and research on cryptocurrencies. Of course, Dimitrios Kenourios, our professor of finance in Department of Economics and member of the council. Francesco Pierangeli, deputy director at the business school in Birmingham University, and also member of the UK Center for Blockchain Technologies. And of course, Panos Xidonas, a very distinguished colleague coming from ESCA University, professor of finance and chairman, of course, of the investment committee. EFCA, as you know, is one of the biggest insurance funds in Greece. So I guess this lovely panel will try to give vital answers to vital questions. So let me start with you, Vasiliki. As you know, the rise of crypto assets and decentralized finance poses major challenges for supervisors like yourself. What do you see as the most urgent regulatory gaps that need to be addressed at the European and, of course, in the Greek level? Thank you.
Thank you, Chair. First of all, let me say that I'm very honored and pleased to be part of this high-level conference. And I want to congratulate one more time your university for organizing such high-level and interesting, I would say, very interesting conferences. So, answering to your question, you mentioned about financial stability. And actually, I want to say that the EU regulation, how it started, actually, why did we wanted to regulate all these issues about cryptos? I think we want to regulate all these issues about cryptos because actually for financial stability reasons. Because I will remind you what happened when Facebook wanted to say that they wanted to issue a cryptocurrency, Libra, the so-called Libra. So all this, I would say the regulation, actually not all, but most important factor was, let's say, financial stability reasons, Chair. So I agree with your how you started. Now, at the global level, the regulatory framework for the crypto assets is still, as we all know, under development. And although a significant progress has been made in the last years, now different approaches have been followed around the globe. Some countries have decided to proceed with a bespoke regime. Some other countries decided to implement or adapt existing traditional financial capital markets regulatory frameworks to the way the cryptos and the cash should operate. So there are different approaches around the globe. Now, the recent change in the US approach, I think, will significantly affect the regulatory landscape. Having said that, let's see what happens in Europe. So in Europe, mainly with MiCA, with a very well known to us regulation on markets in crypto assets, maybe we are the first jurisdiction that had a bespoke regime that was adopted in an effort to provide clarity and certainty for the crypto asset issuers and the service providers at the EU level, of course. Now, this move has advantages and has disadvantages. The advantages can be the fact that they attract market. When we have regulation, there is an advantage in order to attract, let's say, market participants who want to operate in a regulatory environment. So that was the advantage. On the other hand, the disadvantage there exists because there are a lot of challenges that come with regulation, especially where the global regulatory landscape is still under development. So we have competition issues, especially when we're speaking about a global market like the one for crypto assets. So, and the global market is something which, in terms of assets and market operation, is huge outside of EU. So we understand the challenges that this regulation can bring around the globe, because when we speak about EU regulation, this is not necessarily followed by other countries around the globe. Now, Europe's regulator should make efforts to achieve convergent application, and this is actually my answer. What is the gap that we need to make sure that we try to fill in? So one of the gaps and one of the efforts, one of the things that we need to make sure that we proceed with more, let's say, persistence is the convergence among all regulators in Europe at the EU level, because we need to make sure that we always apply the rules in the same way within the EU 27 in order also to have level playing field in the way we approach the market operation of all the cash and in general of the crypto asset market. Also, I think that the EU should actively promote and support the development at the global level of a regulatory framework and approaches that ensure the same level of investor protection and market integrity. We need to make sure that we also try to support this at the global level as well. So Europe, as foreseen in MiCA, will review the application of MiCA within the next, at some point, according to the regulation, as well as the monitoring developments that exist, in order to make sure that we make the necessary adjustments if and when required. Specific focus will be given to specific matters not addressed in MiCA, such as the fully decentralized finance, lending and borrowing, staking, all these issues can be, let's say, the object of a next review that will take place as far as MiCA is concerned. Now, as far as Greece is concerned, we always work together with other European, let's say, national competent authorities and with ESMA, so there is not a specific gap that we alone as Greece need to fill in. The only thing that we need to make sure is that we work for convergence at the EU level and also work locally together with the Bank of Greece in order to make sure that we have a very good cooperation and we regulate efficiently our market, because according to the Greek law, there are some issues for which the Capital Market Commission is, let's say, responsible, and others that the Bank of Greece is responsible. So we need to make sure that we have also a very good cooperation in order to supervise efficiently our market.
Thank you, Vasiliki. Everybody expects so many things from Capital Markets Commission and yourself. I know it's a very hard work because things are changing, or the economy is transmitting to a new era, and we have to check all this stuff. And let me pass to Larissa. Larissa, yesterday we had a big discussion with the governor about the central bank digital currencies, CBDCs, which everybody knows that are gaining the momentum worldwide. And there is a huge discussion about all this stuff. So from your perspective, how might CBDCs reshape the competitive landscape between traditional finance and cryptocurrencies? And what do you think would be the regulatory implications that we can foresee?
Excellent question. I think, first of all, I'm sharing just my personal opinion here because there are so many conflicting views about what the future of CBDC holds and whether government and central bank should introduce them. I personally think it's only a matter of time that it's coming, the change is coming, that central bank digital currencies, digital euro, digital pounds is the next step in terms of the bridging traditional finance and digital finance. It's going to offer some useful tool to increase the adoption of cryptocurrency and digital assets on the large scale. However, there are several obstacles, of course, particularly if you're talking about retail adoption of CBDC. We need to address issues of trust, cybersecurity, so we need to ensure that actually society is ready for this the transformative change. And of course, we can see the popularity of the assets like stablecoins, for example, who are already in a way acting as a liquidity provider on crypto markets. We can see the market capitalization of stablecoins skyrocketed in the recent years, but the markets are extremely concentrated, and we need to understand that stablecoins are owned by private companies. They're issued by private issuers. So if central bank will start issuing kind of similar instrument, how this will affect stablecoin markets, and if it will affect stablecoin markets, how it will in effect affect overall digital asset ecosystem. So I think definitely when central bank digital currencies will be introduced in major countries, in major economies, I would say that we will see quite a big change and potentially quite a strong contagion shock that probably first will hit digital markets. Again, I don't have here a magic ball to see what will happen, right? But I think it will generate strong contagion shock first for digital markets, and after this potentially will start spilling over to traditional markets as well. So that's why I think central bank digital currency are currently under the discussion and alongside stable coins, and that's why regulator is really considering it very carefully and trying to evaluate all the pros and cons before making this big step into the future.
Thank you, Larissa. I know that you do lots of research in University of Southampton and all this stuff, and this really matters to understand what we can do on it. And I move now to Dimitrios Kenourios. Dimitri, from an academic perspective, as a faculty in Department of Economics, that you are doing research on all this stuff and especially risks, what do you identify as the main systematic risk that the expansion of the cryptos and the market might pose to the global financial system?
Thank you very much, Aris, for the question. I would like to welcome you all to this very interesting panel. So we will all agree that the accelerating integration of cryptocurrencies into traditional finance introduces a multiple systemic risk, especially into an underdeveloped regulatory framework. We're all aware that crypto assets are increasingly tied to mainstream markets, further magnified risk. Central banks observe growing correlations and exposures. The ECB finds that during market sell-offs, crypto prices moved more in line with equity markets. This suggests that a crypto shock could now echo through stock and bond markets, and European regulators caution that while no banking defaults have yet occurred, any significant crypto losses at large financial institutions, put some quotes here, could put capital at risk with potential knock-on effects on investor confidence, lending and financial markets. So as regulated banks and funds add cryptos to their books via ETFs or direct holdings, a sufficiently large crypto crash could weaken bank capital and trigger broader market stress. Now, academic and policy research converge on the view that there are three main dominant channels through which shocks in cryptos can propagate to the broader financial system: leverage, interconnected exposures, and stablecoin fragility. High leverage secured by volatile collateral is a major mechanism that could force liquidations, suggesting margin spirals that push prices lower and amplify volatility in both centralized and decentralized finance. Of course, stablecoins sit at the center of crypto markets, yet their runnable structure poses systemic risk. Confidence shocks can spark redemptions that force issuers to liquidate traditional assets such treasuries or repos, mirroring a shadow bank run that exports stresses in markets. The risk is not hypothetical. Take into account and remember the Terra Luna collapse in 2022 or the FTX failure that revealed the dangers of opaque multi-faction intermediaries. To sum up, academic and policy research converge on one core concern: systemic contagion. Crypto markets volatility, leverage, and growing links to regulated finance mean that a shock in a crypto, especially a large levered unwind or stable collapse, could cascade through banks, funds, and markets globally. So we need the regulatory framework to update it, to be developed in a more high level in order to adopt, to cope with all these systemic risks that could be arise. Thank you very much.
Thank you, Dimitri. And I move to Francesco. Francesco, you're coming from University of Birmingham, one of the leading universities in UK. And we know very well that the UK has positioned itself as a potential crypto hub. What lessons from UK's regulatory approach could be really valuable for us, for other countries like Greece, seeking to regulate this sector?
Yes, is mic working?
Yeah. Does it?
Yellow.
Yeah, it works.
Oh, can you hear me? Perfect.
Very well, very well.
Perfect. So thank you so much, Aris. And thank you, Larissa, for having us and organizing this magnificent event. Yes, if you allow me, I would like to start by first and foremost addressing the question in two parts. The first is the UK as a crypto hub, right? You don't become a crypto hub from one day to another. There is work behind it. That's why I just wanted to mention a little bit about the work that we have done in the space. So in my case, I'm the director of the Master in FinTech program at the University of Birmingham. We launched it around 5-6 years ago, and I'm the module leader for the blockchain and financial applications module. And I'm delighted to see that even here at the University of Athens now we have a fully fledged FinTech, very successful FinTech program. But this is very important because obviously everything starts from cultivating talent in order to create that crypto or FinTech hub. I'm also the Deputy Director of the UK Centre for Blockchain Technologies, which is a national hub which brings together 3 leading universities in the country, including Oxford, Birmingham, and UCL. And the idea is behind the centre was to help drive the national agenda for blockchain by connecting industry with university and obviously government stakeholders, including regulators. But we really want to go beyond just connection. We really want to try actively promote the adoption of good use cases for these new technologies. Otherwise, what's the point of us being here in the first place? We are organized across 3 core areas, so 3 verticals. So one is research, the other one is education, and the third one is community buildings. They are all very important and interconnected. So you can think of the research. Obviously, we publish across computer science, economics, finance, law, you name it. For example, we recently published a report with Ripple, which is a leading company in the space, on how traditional finance is investing in blockchain. So we are currently working on a mapping exercise of blockchain activities in the UK, and we will come back to that in a second. Particularly for looking at investment and employment impact of the industry. Education, we obviously deliver teaching at all levels: undergraduate, postgraduate, MBA, executive education, and we also host a number. This is very important. Host a number of seminars and workshops that are public, open to everybody to just come and attend and learn about these new technologies. Finally, the community building aspect is very important too, because we organize hackathons and we try to connect students with entrepreneurs or turn students into entrepreneurs in space. Again, why we want to do that? Because if we retain talents, if we cultivate those talents, eventually they may go on and create a unicorn and push the boundary forward. Beyond those activities, we closely work with the regulators and policymakers, and that is the core of the discussion today. So we have worked both with the FCA, which is the Financial Conduct Authority, which is the regulator in the UK, and we also work very closely with UK Parliament, both House of Lords and House of Commons, along with also trade associations. Trade associations is also very important to think about. The Digital Pound Foundation in the UK, as everyone knows them as well, Innovate Finance, and so on and so forth. Now, to your question, what we can learn, the lesson learned, I wanted to start, there is good news or bad news. Good news is that we can learn a lot. Bad news is because we've made a lot of mistakes in the UK. So we can learn a lot from those mistakes. So it's a good thing to share. So what are those mistakes? So for sure, we in the UK, at least at the beginning, we approach this in a very fragmented way. I heard Vasiliki say very, very rightly that everybody needs to coordinate with each other and come together. And that is exactly what the UK has not done. And that was the biggest challenge. So we had some promising initiatives that were fragmented, that mean across the Treasury, Bank of England, FCA, the regulators. So all of them, they launched good initiatives, but they were not coordinated with each other. And therefore, what happened then? There was no action following those. Not much action was shown after those consultations. And what was the ultimate result? Was legal uncertainty and high compliance costs. A lot of companies that famously tried to get approval from the FCA and whatnot, they were rejected, and they were completely legitimate, tried to do all their best, and yet not being successful. And what is the result of this? Discouraging investment. In fact, in the UK, we have seen the FT going public, saying a couple of years ago, making a big fuss about Andreessen Horowitz, which is one of the most famous venture capital firm in the world, sometimes called A16Z or Z, depending on how you pronounce it, establishing a big London office. And then, after 2 years, so I met also with the partners and whatnot, they were very excited about being in the UK. And then after 2 years, they decided to shut down that office, and was a big loss for the country. And by the way, just to put this in context, the UK, the white paper, the Bitcoin white paper, is written in British English, and one of the co-founders of Ethereum is British. He's a British scientist, and it's quite good, because then when he left Ethereum, then he went on and founded Polkadot. So again, another top 20 is Gavin Wood. So it's and then Adam Beck, which is supposedly one of the people that people say Satoshi Nakamoto is a British cryptographer. So I mean, so it's not like there is a reason for those crypto venture capitalists to be based in the UK. And if even they decided to leave, probably there is a problem. However, enough with the bad news. Just very briefly, and I will done. So the recent we have witnessed a recent positive shift. So in last year, the government coordinated with the Treasury, the Bank of England, and the FCA launched the Digital Security Sandbox, or DSS. So this is a way to allow firms to experiment directly with DLT on real securities. So think about bonds, equity, and so on. And therefore, they receive full backing from the government, and the UK pledged in March 2025 for the first time to begin procurement for a pilot of digital bonds, so to issue bonds. So those are the type of things that we have seen, and I think that is a big lesson that we can learn.
Thank you, Francesco. I know that you can talk about this stuff for a year, but let me ask now. I move to Panos. I know, Panos, that you are doing lots of research on cryptos, and from the perspective, though, of having another hat of a large institutional investor such as EFCA and working for it, what are the necessary conditions for cryptos and crypto-related assets, you think, in order to become part of pension fund portfolios like EFCA?
Good morning, everyone.
Πάτησε το λίγο.
Good morning, everyone. Mr. Vice Rector, thank you very much for this invitation. There is no doubt that cryptos have moved to the financial mainstream, and with daily trading volumes of approximately $100 billion per day, there is no doubt that Bitcoin and Ethereum are now impossible to ignore. However, there is a small problem. Bitcoin's long-term annualized volatility is roughly 68% compared to the 12-15% volatility of gold and the 15 to 20% volatility of the US equity market, the large cap US equity market. Actually, in its wild phases, Bitcoin's volatility has surged to 6% daily, which means approximately 95% annually. And for sure, that's a level that many pension mandates feel very uncomfortable and inconveniently with. We have some more recent figures. The 99.5% confidence level value at risk for Bitcoin and Ethereum is respectively from 75 to 90%. So these figures are really massive, are really enormous for a portfolio, especially for a pension portfolio. Now, about us. As a pension fund, the Social Security Pension Fund of Greece, our primary mandate is to preserve capital and deliver long-term sustainable returns for our future retirees. Okay, and we are talking about a country that after 10 years has emerged from a very huge decline in its GDP. So there are many conditions and that cryptos and crypto-related assets that should be met in order to consider these elements as potential investment choices. Number one, as Chairman Lazarakis said, clear regulation and explicit legislative rules. I mentioned the MICAR, the IORP2 directive, the EIOPA technical advice. Number two, we need a very strong custody and cyber-secure market infrastructure. This is extremely important. Number three, we also need transparent accounting and valuation pricing methods. Number four, we also need very strong empirical, historical risk-return diversification benefits. Yesterday, we have presented a paper, a very technical paper. We were trying to document the safe haven character of cryptos using a quantile guards econometric model. Safe haven not in terms of the volatile nature, but in terms of the correlation of the element. And the answer is yes, that typically it could be a potential. I mean, to use cryptos under specific conditions as a correlation stabilization mean. And of course, number five, we also need alignment regarding the ESG rules, of course, because the energy consumption of the underlying technology. So for a pension fund, all the above boxes should be unconditionally ticked. Overall, I would say that we certainly need a very solid regulatory balancing act, okay? Because technology needs to have safety belts. And actually, allow me to remember the collapse of the Terra USD in 2022 that wiped out billions of dollars and triggered the domino effect with the bankrupt of funds like the 3AC, the Celsius, etc.
Thank you, Panos. Thank you so much. Thank you for taking care of our pension plans. And we all Greeks expect a lot. So I move now to Madam Chairman. How can the Hellenic Capital Market Commission strike a balance between ensuring investor protection and fostering innovation without shifting the growth of the crypto ecosystem?
Thank you, Chair, for the question, because innovation is a must and we should always support innovation. We should not forget, however, that the primary objective of authorities like us, like the Hellenic Capital Market Commission, both as regulators and as supervisors, is investor protection and, of course, market integrity. Of course, our approach to regulation and supervision should not raise unnecessary or any kind of unjustifiable obstacles to the development of any market, including the crypto assets market. So let me say that the innovative character of the crypto asset markets, which raises more novel risk for investors, as we heard earlier, including the risk of the blockchain technology. The fact that for a long period of time, this market was operating outside any regulatory perimeter at a global level, the different approaches to regulate the capital, the crypto asset market that exists today, and we heard about this as well, and the different, let's say, the increased cross-border functioning of all those providers that are providing services around the globe makes striking a balance between investor protection and fostering innovation a multi-layered and particularly demanding task. Now, having said that, I am reminded of my, let's say, my previous years when I was working as a lawyer, and there were some investment bankers coming to me, and they were telling me, okay, we have a new derivative that that we want that you check before we take it out to the market. And I remember I was looking in all the details, the way it operates, and I was trying to make a sanity test to see how this can, let's say, fly within the regulations. So why do I say this? Because this is the work that we always make sure that we do. Whatever the product is, either we speak about the crypto asset, which is a new thing, or we speak about another asset, which is more traditional, or we speak. So this is the work that we always need to make sure that we do as regulators for sure. So my proposal, and I think what we need to make sure in order to be successful, such an effort needs to be based on adequate knowledge and skill acquisition, as well as on the willingness to work cooperatively with other regulators and supervisors and market participants as well as the fintech industry, because we need to understand how fintech works. We need to understand the novel ideas in order to make sure that we all work together at European and at a global basis so that we can then find this striking balance between investor protection and market integrity, which is the major role, of course, and also to make sure that we support at the same time innovation. So this is, in my view, what we should do.
Thank you. Thank you so much. And you give me an excellent pass to say a few things about the initiatives of the University of Athens. We have already established the Greek FinTech Hub with Archimedes and other very respected members of the ecosystem on fintechs, and we are expecting that to be extended to other fintech hubs and innovation hubs in Europe and globally in order to make a kind of a bridge of collaboration on all this stuff, because things are changing, the economies are changing, and all the regulators, bankers are looking from the academia as well, a kind of support. Because all the research on these cryptos and innovative assets are made by university professors and not only. So based on that, I would like to move to Larissa and ask you, I know that you are doing lots of research as well at your university, and your research has shown the importance of spillovers and systematic risks in crypto markets. So my question is, how can international regulatory coordination address these risks while still fostering innovation?
I think Professor Knorges already really well explained the mechanism behind spillovers and contagion and how the systematic shock can really transmit. So I think I will just jump straight away to the second part of the questions in terms of how more unified regulatory efforts can help to make the environment safer for all the actors. And here I want to just echo the point that made Vasiliki, and I think Francesco also mentioned it as well, that it should be a perfect balance between protection of consumers, protection of all the players and actors, but at the same time to not damage innovation in the field. And what we have in right now, because of this ambiguity in terms of the regulatory framework, that companies coming from one country to another, they're migrating, that we are losing lots of talent as country in UK, for example, and in general we potentially losing a competitive advantage to some regions that are more open to crypto and to innovation and that's driving entrepreneurial spirit. So I think this is quite a problematic thing in terms of how the field will develop further. Another quite challenging issue, in my opinion, that I don't think we discussed yet. It's how actually amount of potential unethical behavior that are happening in the cryptocurrency space that carving trust to any crypto assets and any securities. And media, it's one of the biggest channels of transmission, not only information, but a transmission of any volatility shock, contagion shock. And I think what we currently can observe, especially with the spike of AI usage, that it's becoming increasingly easier to manipulate public opinion and to manipulate opinion of investors and consumers and users. And I think it's a very tricky area for regulators to address in order to protect from fraud, protect from excess market volatility, and actually make space safer and make products that are currently being launched more safer for consumers. And also another point, probably final point I want to make is some good case studies that we need to embrace, consider, and basically studies, academics, because so far we don't have much more successful case studies apart from digital finance, digital assets, and I think this is also part of the problem because blockchain technology and fintech, it's a lot bigger than that, and there are potential other user cases that can help to address several emerging problem and old problems that we are facing in society. And I think if we can highlight how these good actors in the field and how these transformative projects and the results and the impact that they're having more, this also might give regulators better guidance on which type of innovations to support and which type of, I would say, more damaging market manipulation and hyped up of innovation might be not needed because it doesn't serve the purpose to country, doesn't serve the purpose ultimately for the community.
And what to avoid. Thank you, Larissa. Dimitri, you're working in a university like Athens University, which is huge. And my question is, how can really universities and academic research contribute to the design and the decisions of more effective regulatory frameworks for crypto markets? How can we help as University Vasiliki to make it easier?
Thank you, Aris. I think we will all agree that universities and research centers should and must play a pivotal role in shaping crypto regulations by combining evidence-based analysis, structured guidance, practical experimentation, direct policy input, and capacity building for regulators. To be more specific, academia so far translates complex protocol mechanism into regulatory language, producing taxonomies of risk, stress analysis of market dynamics, and clear metrics that supervisors can integrate directly into policy frameworks. Universities also design policy toolkits. An example is the Wharton Decentralized Finance Policy Maker Toolkit. So regulators can align on structured risk channels and regulatory levers across jurisdictions. There is several reports of World Economic Forum that highlight that such toolkits result from international collaborations among academics, legal practitioners, regulatory experts, and offer a solid foundation for understanding the major factors that should drive policy-making decisions. University labs, on the other hand, act as collaborative test beds where academics, regulators, and industry co-produce solutions, testing stablecoin redemption mechanisms, running stress simulations on decentralized finance protocols to ensure choices are anchored in empirical evidence. Academics also contribute directly to legislation and supervision through expert testimony, comparative frameworks, for stablecoin regulation and drafting inputs that harmonize domestic laws with emerging international standards. Finally, I would say that academia advances education and capacity buildings, training regulators in technical, legal, and market aspects of crypto via executive programs, open data dashboards, and recurring policy conferences, such the one we are all today, that cultivate enduring communities of expertise. Finally, I would say that it may be a problem of coordination. Francesco mentioned it. In order to ensure that we all be at the same page and to be more effective, we have to work on this matter, how to coordinate all these stakeholders in order to be more effective. Thank you.
Thank you, Dimitri. And Francesco always says the truth. That's why I know, Francesco, I'm a bit confused with blockchain, with the complexity of blockchain. And my question is, should regulation remain technology neutral? Or should it be more tailored depending on the type of the crypto asset? What do you think?
So I think, oh yeah. Well, okay. First, I'm confused too sometimes. I have to admit. But thanks to Dimitrios, for reminding all the amazing work we do. So it's good to hear also sometimes, that yeah, oh, actually we do that. We do 1, 2, and 3. So it's good to have that perspective as well. Yes, in terms of technology neutral. Vis-a-vis what could be perceived as a more tailored regulatory framework. In the UK, we've been favoring more the principle of technology neutrality. So it doesn't matter whether a certain asset is traded on A, B, or C platform or uses a certain technology. It's just the regulatory framework should address function and risk, and so therefore function and related risk. Not the underlying technology per se. However, we also highlight how this approach, there is no one size fits all in blockchain, particularly in digital assets in general. Why? I'll give you an example. So stable coins, clearly, they may potentially have, with all the brilliant researchers that we have listened to this in this conference, they may well have systemic and financial stability issues. But that is not exactly the same for, say, NFTs or digital art. So those are two types of digital assets that can be both transacted on DLT platforms, but they obviously do not require similar regulatory framework. Utility tokens in DAOs, for instance, and the DeFi protocols, again, completely different type of animal in a sense, right? Completely different species. So an hybrid approach has been emerging in the UK, which proposed like a regime to separate activities. So say custody, who is in charge of custody, who is in charge of issuing it, who is in charge of trading, who is in charge of eventual lending, with all the different aspects that those activities entail. So I guess that is a good balance to find. Trying to obviously be technology neutral, but also take into consideration the activity and the risk that carries with it. But there is a key insight also that is important to share, which is the experiential gap. Oftentimes, this is less nowadays, but certainly more in the past, the regulators were asked to regulate technologies that they were not really familiar with. That's why I really appreciated listening that once you were mentioning earlier, once somebody, an investment banker comes to you, you're like, okay, let's stop, let's run our tests and see what happens. Developing that familiarity with those new type of digital assets is really crucial, and not all regulators around the world. Obviously, Europe is in a privileged position. The UK has all the resources that they need, but a lot of regulators around the globe may not be as well equipped. So it's very important for us, particularly in Europe, the UK, US, to coordinate globally and try to set the standards, because if we don't do it, somebody else would step in and do it.
Thank you, Francesco. And finally, at the very end of this round of questions, I will move to Panos, and after that, we're going to have a Q&A session. So you can ask whatever you like on our lovely colleagues about cryptos. So Panos, what risks and potential benefits do you foresee for pension funds if they were to engage with crypto assets in the future?
So in simple words, focusing on risks, on the risk dimension, the European Union is telling banks and the market something very clear. If the crypto asset is backed by something real, we will treat it like that. If it's crypto, only crypto, or mixed, we will consider it as super risky, and you will need a lot of capital in order to hold it. Examples: stable coins are associated with a risk weight which is 250%, and cryptos are associated with a risk weight which is 1,250%. So the difference is huge and mirrors the risk exposure between these two elements. So the risks are obvious. Number one, extreme volatility. Number two, uncertain regulatory treatment. Number three, cybersecurity and the underlying technological vulnerability. And number four, perhaps liquidity gaps. This is also very serious. So the above make crypto difficult to reconcile with the mandates of a pension fund. However, at the same time, there are potential benefits. Number one, it is a technical benefit. It is associated with diversification. Over long periods, it seems that the correlation of cryptos to equities over the last 10 years is approximately 0.2, which is a very optimistic figure. Perhaps cryptos might operate as a correlation safe haven element. Number two, this is also very serious. Cryptos perhaps could be a hedge against inflation if we want to connect these two elements, the macroeconomy and the risk behavior and the risk profile of crypto elements. And of course, if we talk about the deep tech issue, the technology, the blockchain technology indisputably brings efficiencies in terms of the settlement, the transparency, the cost reduction, and stuff like that. So in my view, the most prudent path for pension funds for sure is not to ignore cryptos and monitor the developments. The path will be a long road path, and perhaps engage in the dialogue with the regulators, the market participants, etc. A very last figure, according to EIOPA, for 2023, the European Union insurers held 655 million euros in cryptos. This is something like 0.01%, but perhaps it can be a good starting point.
Thank you. Thank you so much, all of you, for your insightful views and answers to these questions. But I still believe there are many questions to come from the audience and our distinguished guests. So I will open the floor now to your questions, and we'll be glad to receive it. Yes, please.
So first of all, thank you for an informative panel. When I look at the spectrum of caution versus optimism about the future, the panel I think is more on the cautious side. And what I hear is volatility and risk increase the alpha, you can decrease the beta. So why are we not talking more about the opportunity and less about the caution, which is what we've been doing in the last 5 to 10 years?
Vasiliki, please. Let's start with you, and then we move to Panos.
I understand your point, and I think that we are discussing about opportunities, and I think and especially you spoke about the interesting novel, let's say, issues that came up from the laboratories, especially and from fintech and industry and all this. However, when we speak about something new and about novel, this is what that was at least my point, was that always we need to make sure that we try to, when I speak about sanity test, what do we mean? We mean that we always, when we speak about something novel, a novel idea, we need to make sure that that novel idea does not contradict to any kind of, let's say, other interest of other parties, such as the investors, for example. So when we try to design something and see how it will work, we need to make sure that we always have in mind also other considerations like the risks that we heard. So whatever is novel may have also risks. So we need to study the risk. We need to make sure that we use the empirical studies that Dimitris mentioned. And then we try to see how this can be regulated in order for this novel idea then to make sure that can be used for the better, let's say, of the markets and of the economy and for all these issues. So I think that right now the reason for having this discussion is because we're right now at the stage of trying to make sure that we have understood all the relevant risks and we can deal with all the relevant risks. And this is why the discussion right now is about recognizing the risks and then trying to see how we can then increase and develop actually the relevant market. So yes, digital market is, I mean, tokenization is an idea which is very forward-looking and will have, I mean, it's the new thing. Everybody speaks about the tokenization right now. In IOSCO, and Manolis Arvanidis is the representative of the Hellenic Capital Market Commission is in IOSCO, and I see him here. They are now discussing about many more things that we're discussing here. They are discussing about the tokenization, about the digital assets. They try to have coordination, because we also talk about coordination at a global basis. So this is the discussion right now for the regulation. And the good thing is that we try to hear what the market says and what the market participants say and what all the stakeholders actually have to contribute to this discussion. So this is important. We are not pessimistic. Actually, we are cautious because this is the role of the regulator. We always need to make sure that we as regulators and supervisors have thought of all the risks, have thought of all the relevant parameters that exist there in any product, and have then thought of how the supervision will take place. This is why you hear us to be cautious. This is our role.
Thank you, Vasiliki. And let me add something on that before I give the floor to Panos, that in the university, you know, we are very conservative. And this is an old university. And believe me, the ideas of cryptos and digital assets, even though it's a big debate for us here, still is a question. That's why we are cautious, and that's why we are here. So, Panos, the floor is yours.
Under the role of my consideration, I have to be pessimistic, not only in terms of the technical side. Behind you is sitting the managing director of the Social Security Pension Fund. I am the chairman of the investment committee. It is impossible one morning that we will go to the governor of the Social Security Pension Fund, one morning to go to the governor, to the minister, and to come up with ideas about the cryptos and telling stories about diversification and stuff like that, especially for a country that for the last 10, 15 years has suffered a lot. So there is a red line for us right now. We are able to engage in discussions about cryptos. We are very happy to discuss about GARCH models, volatility models, correlations. We are happy to have our students make research on that, but until Chairman Lazarakou and her colleagues in the European Union give us the green light, we have nothing else to do.
Yes, please. Thank you very much for your very interesting views on the topic. I would like to stay and elaborate more on a point that Vasiliki made before regarding the convergence of regulation across Europe. From my research, we show that cryptos have some similarities to bills of exchange, which was historically a prominent form of money, private money, that dominated in Europe before the establishment of central banks up to the end of the 19th century. And they have some similar cryptos and bills of exchange have similarities. For example, the blockchain technology during bills and for bills of exchange we have the endorsement, but there is one big difference that during centuries bills of exchange operated because there was a stable legal framework across Europe where you could go to a notary and basically show your bill of exchange, and it was backed by all the people that signed the bill of exchange, similar to the blockchain technology. So my question is that why does it take such a long time to converge in regulation, to establish a clear regulatory framework nowadays?
If I may speak about Europe, in Europe there is one regulation, which is the MiCA, the markets in crypto assets, and it was the reason for having one regulation and not a direct, let's say, which could be implemented in different ways in the member states, was exactly because of what you mentioned. Because the idea behind this regulation was to make sure that there is same application all over Europe for the specific rules. And also this is the effort among us as well, because at ESMA level we also do this kind of work for the level 2, for the Q&As, for the legal opinion. ESMA has issued legal opinion for several issues like the broker model, and all the efforts that right now are in order to make sure that there is the same application all over Europe. Now, having said that, of course, we as regulators and supervisors, we need to make sure that we also overlook our market and make sure that we monitor it in the correct way. So there is sometimes when you can find differentiation among the relevant, let's say, supervisors. However, all the efforts are in order to make sure that we don't have any such differentiation. This is a long path to go, and we are working on this. There's a specific, let's say, there is a specific working group in ESMA called the DFSC, Digital Finance Working Group, which actually we have two representatives here in the audience, Mr. Asiopoulos and Mrs. Terioula, that follow the relevant work of the DFSC, which actually is doing exactly this issue. What is trying to make sure that there is convergence, and that the way that we deal with CASPs, let's say in Greece, is exactly the same with the way they deal with CASP in Germany or in Italy or whatever. Now, having said that, I think that in Europe there is a lot of efforts. There are a lot of efforts in order to make sure that we have convergence. What is missing is the convergence on the globe, and this is why I spoke earlier about this kind of convergence. Because when we speak about cryptos, we're speaking about something which has a global dimension. It's not European. It's sure because of all these cross-border activities that exist, we're speaking about something more global. So that is missing. The convergence and the coordination among all of us around the globe is missing. And there are a lot of efforts that IOSCO is doing in order to make sure that we all at some point are converged and coordinate. But there is a lot of work that has to be done in this respect. Now, why is it difficult? Because of competition rules, because of different mentalities around the globe, different perception, different interpretations, and all these relevant issues that I'm sure that our colleagues on the universities are better. They know better why some of the issues why you see in some places that there is bespoke legislation, and in some other places there is not even a discussion about cryptos. So these are all things that we need to deal now and not later, because it is a global phenomenon and we have to make sure that we deal with it the soonest possible.
Thank you. Yes, Hussein.
I have a question for Vasiliki. You mentioned
Hussein, not only Vasiliki, there are other guys here. Vasiliki, I know is your favorite, but okay.
I do work on regulatory monitoring, specifically with the College of Mining University of Birmingham, and you mentioned regulatory monitoring. And I'm not going to put names, but for example, there are cases of money laundering after the Russian invasion to some Russian elites through an exchange in Greece. So how can academics work with you to further do this regulatory monitoring that you mentioned?
Sorry, because you mentioned something that was not clear. You know about a Greek entity that does
That is used for money laundering.
is what is used for money laundering. So we need to speak later. That's the first thing. So having said that, let's see now how we can take advantage of the work of the universities. Okay, we have discussed already with the chair and also with Professor Xidonas and Professor Kenourios, and we want to cooperate with the university and not only, and with other universities as well, in order to make sure that we become more aware of all the empirical studies that you have already, and see how we can, in practice, make use of all these excellent studies that exist, and see how we can further use this in our supervisory work. This is our intention, and we have done it in other instances. We have started cooperation in other instances. For example, for portfolios, if we can say, we are building. We are building together with the university. We are doing a research. You are doing a research, and we are doing it together to see whether
They pay the money.
we pay the money. They're doing the research for seeing how we can use the portfolios for the asset managers, and so how we can deal with portfolios to make sure that we have specific allocation issues and all this, and to explain this to the audience, to the investing public, so that they understand how the portfolio, let's say, works. So we have done such kinds of cooperation, and we will continue this kind of cooperations, and especially in the area of cryptos, and this is what we're discussing before we come here.
So, we have to let the people know here that the Hellenic Capital Commission, in conjunction, in cooperation with the universities, the Bank of Greece, do a very good work on financial literacy. That is close related to cryptos. We have to know all from our child year what is finance, what is money, what is, in order to go to more sophisticated tools such as the new cryptos or the stable coins. So I have to mention that Vasiliki did a great work in financial literacy, and we are much more. We have to make much more things with Yannis Sounaras and with other universities in that topic. Thank you.
Thank you, Dimitri. Panos.
In my opinion, what you have said, you have made you have expressed a public opinion right now. What you have said is very serious. So if you have information that there is something ongoing in terms of anti-money laundering, you have to go to the Greek authorities. This is very serious.
That's the thing, the work that we do.
Is it a rumor? Is it a rumor?
It's an actual work. So the work that we do, we use public blockchain, like Bitcoin blockchain addresses, and public information like these people are under sanction for Russian money laundering. So for example, there is a lady that is called the Russian money launderer for Russian elites. And you can exactly see on Bitcoin blockchain, the Bitcoin from that lady goes to some of the exchanges active in this country. So it's a public thing that we can see, but the thing is, we do this, we put all of this information together and we show it. But that's what I was saying. We do this, we have expertise in this.
Okay, this is excellent. It's a crypto exchange,
Yes.
which is not yet authorized. It's not licensed yet. Okay, so this is why I say you need to tell us exactly what is the case, so that we know.
No. Before you leave this room, you come in my office. And then I tell you where you go. The lady there, yeah.
Yeah, just very briefly, I think if answering your questions from the side of stablecoins, how many stablecoins do we practically need again, right? They're already basically Tether and a couple of others do the job for the whole crypto markets, but we are still, and lots of new projects are emerging at the moment, and there maybe competition will increase in the future. Banks are also discussing to potentially launch their own stable coins before CBDC even going to be announced. I think ultimately if CBDC will get introduced, that will give such a great boost in terms of investors' confidence and consumers' confidence in this new technology. Therefore, I think it will be very strong competitor potentially to the stablecoin market. Therefore, of course, the giants and the largest stablecoins probably will not get substantially affected because they already have their niche, they have their clientele, they have their user cases. But if you're talking about newer projects, then for them, this might be a kind of a bit of a deal breaker because they could be already too late to join the game when already such a giant players will become active. Hope I answered your question.
Yeah. So,
Francesco.
and just to recap very quickly, touching just one sentence on the previous questions as well. Well, I'm the deputy director of the UK Centre for Blockchain Technologies, not against blockchain technologies. We're talking about pessimism and optimism. So it's for blockchain technologies. And believe me, it wasn't easy to convince Oxford, UCL, and Birmingham to create a centre for blockchain technology back in back in the day. So that's one. Number two, in terms of what changed in terms of regulatory framework? Well, the number one change that really completely changed the landscape was the U.S. election. U.S. election completely changed the game in the U.S. And we know that pressures from the U.S., doesn't matter if you are for or against Trump, it doesn't matter, but certainly changed radically the narrative on digital assets. And to give an example in terms of institutional investors, I think there was a news, don't quote me on that, but it should be from the regulatory authority in the US overseeing loan markets. So there was instructing the Fannie Mae, all those gigantic institutional investors to force them to accept crypto as collateral in case of a loan. I don't know if it's but so those are the type of examples where institutional investors are being instructed to create frameworks where, and the regulatory authorities are instructed to create rules around bringing crypto in. And to finally address your question and brings everything together, we are, so at the UKCBT, we are working with the colleagues at Nova in Lisbon and IE Madrid, and perhaps probably we will discuss this later with you guys as well. So we are creating in order to reduce that, to analyze the mindset, the different mindset that is that a lot of different approaches that a lot of regulators have around the world. We are creating an AI-based regulatory mindset survey, which is basically MPs, members of parliaments, can take. Is a normal survey, but there is AI in the back analyzing the answers, and that this AI engine maps the answers of those parliamentarians into five different regulatory mindsets. So we have innovation first, or a very precautionary one, so on and so forth, in order to understand where do, say, parliamentarians, what type of mindset do parliamentarians in Greece versus in Spain versus in Portugal versus in the UK or the US have in terms of approach to regulation in digital assets. So this is an example of how universities can contribute to reduce the fragmentation and say, okay, guys, if all of us are precautionary, well, we can probably do something about it. If all of us agree that this is, it should be innovation first, then let's go for innovation first. Let's continue push the agenda in that sense.
Thank you, Francesco. I think we have time for two more questions. Yes, please.
Thank you. I'm going to go with what Francisco said. From entrepreneurship perspective, how the European Union plans to the regulation compete with the US? And you see, like you just mentioned, like in the
is a question that should be addressed to the policymakers of the EU because they have already brought up the so-called SIU, which is the new thing that tries to see how we are not going to leave all the let's say all the startups and to go to the US and try to keep them here and try to find try to see how we can assist them raising money and all this. So this is a continuous effort. We understand that as far as startups are concerned, they prefer to go to the US, which is clear, but I mean, this is our efforts that are being done by the EU at a more central level. So I'd say it's not for us to answer this.
Yes, please. Yes.
First of all, congratulations on the panel. It is an excellent panel that converges academia views with the regulators' view. Just one example, what Francesco said about the US administration. In August, there was an executive order by Trump called a very catchy title, Democratizing Alternative Assets for Investors. These alternative assets include also crypto assets. And this order was addressed to institutional investors, not only but also pension funds, instructing them to invest in cryptos. So this is a perfect example, and I think answers all these problematic about how the global approach is towards cryptos. Because we have one pillar which is the EU and the other very powerful pillar which is the third countries like the US who have a certain very firm and strict policy towards for cryptos. And this is why there is so it's very difficult to achieve convergence in the global scale. This is what Mr. Key said, and this is something that we all face almost every day when we read about executive orders like that I mentioned. And this is a struggle that regulators, but not only regulators, but are in the second level, because as he said also, this is a matter of policy and a policy on a global scale, and this policy is not yet formulated. We don't exactly know where we're going. And this is a matter also of competitiveness of the US, of the EU towards the market, the huge market of crypto market in the US. So this is something that we will all have to deal in the near future. And I was very concerned, terrified, I must say, when I heard Carlos, the first answering a question about the pension, the Greek pension funds regarding cryptos, and terrified as a regulator also, because we had to see whether there was accurate information about risk management and about the disclosure of information to the public about what the pension funds are doing. So this is it was terrifying at first, but then when you explain, I feel more have more comfort now.
Panos is a
But
very
you are,
good
you
guy.
are sorry, Vice Rector, you are 100% correct. There are absolutely deviating beliefs at the political level. So this is a very strong point.
No, no, Dimitri, yes.
Just to add some thoughts. I don't know if the global regulatory framework will be it is an expectation or will be will take into account we have a global regulatory framework in the future. Until then, I would say that we all have to take into account the regulatory arbitrage that could be in work until then. And let me mention a paradox. We all want a more regulatory framework in stable coins in this new technology. But there is a study, I think it's Draghi study, that says that Europe, in order to compete with the other players has to be to lower the regulation in the markets, or just to have in mind that there is a balance to take into account where we discuss all the things. Thank you.
Thank you, Dimitris. And I think the time is up. I will give you the chance for the last question, and then I'd like to wrap it up a bit. And then we go out for having our lunch. So, yes, please.
Very briefly, we compare the consequences of the Genius Act with the consequences of MICA. I mean, MICA came before the Genius Act, and just after the Genius Act, we have seen a lot of statements coming from big private companies. Google announced the creation of its own private blockchain, the Google Cloud Universal Ledger. Circle announced the creation of a private blockchain. Just after that, Amazon announced the creation of a stablecoin. Walmart announced the creation of a stablecoin. How can we explain that after MICA, we did not encounter such incentives to innovate?
Francesco.
I think it's an excellent point, and I was invited by Google. I was when they presented the Google Cloud Universal Ledger. I was the only academic there as well, which also tells you what how they are moving so fast, and even for us academics it's difficult to catch up. Um, and the reason is very simple. It's just they don't have that fragmentation in terms of market. They try to lower barriers instead of erecting them, and they are very, very clear. Although the Genius Act on the one hand attracts a lot of talent, but then there is a kind of an erratic policy making in the US as well, with what is happening with the H-1B visa recently. So you may not be able to attract talents as freely as you were supposed to, and Europe and the UK can gain advantage of the US for that. But yes, it comes from the top, and the top, when you have a US president so vocal and so open and so clearly pro crypto, helps. When you have a government in Europe, or in national states, or in the UK, which is telling, nobody's going to say, oh, we don't want innovation. Nobody's going to say, well, we don't want fintech. Everyone is going to say, yeah, of course we do. But then from moving from words into actions and policies that actually can attract. In the UK, the example that I made earlier regarding A16, Anderson Horowitz, moving to the UK, opening shop, a big promotion. Financial Times article didn't really last more than 2 years. Then they shut down the office.
Larissa.
Yeah, may I just add one point to it, also kind of not in defense of academic community, but probably it will be useful. There are lots of academics in this room that often probably you hear in this point like, oh, but industry went so far ahead, or the debates are evolving so much beyond academia, etc., and certain academic views and even academic opinions often unfortunately getting ridiculed rather than deliberately, or just by accident how it's happening. Because in my personal view, when we answering some complex questions, answers are rarely fun. They're often also very complex. Might sound a little bit boring. Truth is always very, very complex. And often when truth is reduced to very short slogans, not going to mention some names, I'm pretty sure you know many of examples like that, then probably the point when you need to be cautious, and start thinking. Therefore, I want to encourage academic community to be very brave, be very bold. The research that we are doing, extremely important. It's cutting edge. It's absolutely, your opinion is extremely important, and therefore never think that what we are doing here is in any way or by any means are not significant, because we are achieving and accomplishing much more bigger goal because we're trying to provide unbiased opinion, we're trying to provide scientific evidence, we're trying to provide the actual data to equip and to inform policymakers. We are not just trying to get likes on social media here, right? We are trying to actually to change and to transform society for the better. Therefore, I want really everyone to be very, very proud of the research that you are doing.
So, in that point, I'd like to give the floor now to Madam Chair of Hellenic Commission for the Capital Markets to say a few things and end up today's lovely session. And I want to make an announcement that the closing remarks and prizes for today's and this conference will be in this room, 4:30. And will be the announcements, I guess, for the best papers and next conference and all these details in amphitheater. And when we end up, I'll be so glad to have you all in the lunch and we make discussions and networking because the questions will never stop. Okay? So, Vasiliki.
So as a sum up, let me say that I will say about three things. The one is that we all agreed that coordination is necessary. And when we speak about coordination, this is something that is being done at the IOSCO level, which is the International Organization of Security Commissions for us, the regulators and the supervisors of securities markets. But we're not speaking about one regulation. We're speaking about different, equivalent, actually, regulations among the globe, equivalent in the sense, in the term of having, let's say, ensure the same level of investor protection and market integrity. So this is the goal, to have equivalent market, equivalent framework around the globe. The second one is about, and I liked what Francesco and Larissa mentioned earlier, about the work and insight that all the academics have, that work, I mean, with cryptos and with the blockchain and with the fintech have in relation to all these issues, which is very important. And we heard about the insight of Dimitris and Panos regarding the pension, regarding the risks, regarding everything, about your novel issues that you have described. And research, Clarissa mentioned, is very important. So understanding of what is happening in the crypto system, in the crypto ecosystem, is the first thing, is the first step. This is a major thing, and research is excellent, so we need to make sure that we make use of all these empirical studies and of all these researches that have already been produced. And I'm finishing with the third thing, which is cooperation. So for me, what is very important right now is cooperation. Cooperation with regulators, cooperation with the industry, cooperation among universities, industry, and regulators and supervisors to make sure that all this excellent work, somebody said amazing work, I think Francesco, you said after Dimitri's points, all this amazing work that has been produced by the universities can work for the advantage and for the best interest of our public and of our investors.
Thank you. So thank you again for being here with us. I'd like to thank all the panelists here. I would start with the ladies, Larissa and Vasiliki, Panos and Francesco, and of course Dimitris, for insightful views. And we'll continue our research and collaboration with the institutional views of the Commission. And the new era is coming, so be ready. Thank you.
Well, hello everyone. Thank you for the few of you that are here today. My name is Diego Barrio Rezuelo. I am a third-year PhD student in finance at the Catholic University of Louvain, Belgium. and I'm really happy to be back here at CRC. I will present to you the third paper of my PhD, which is called Speaking to All, the Economic Impact of Inclusive Language in Entrepreneurial Finance, which is a collaborative work with James Lewison and Karin Sarada-Christia, which are also professor of finance at my university, Özgür Arslanayadin, professor of finance at the University of Illinois in Chicago, and Jennifer Tewison, professor of linguistics at the University of Antwerp. So, what I really liked about this paper is that it looks at how inclusive language can lead to initial coin offering success, which is a timely issue now. Indeed, you may have seen it, the recent years, and more especially the recent month, have experienced a substantial backlash in terms of DI-related initiatives, also in terms of DI-related language. As an example, this occurred at the legislative level, where some countries such as the US or even European countries such as Italy have made legislative efforts to restrict the use of DI language. But more recently, symbolic decisions have been made to reinforce that idea. On March 7 of 2025, the New York Times published a list of inclusive terms and expressions that were considered for removal by the US government, following the adoption of the Trump administration. So this sent a strong signal about the position of the US government towards DI initiatives. Well, looking more precisely at this list, we see that it includes 192 terms and expressions that encompass different aspects of what inclusivity can be, related to gender, sexual orientation, ethnicity, or even mental health. And in this paper, we are particularly interested to look at the impact of such words on companies' ability to raise capital, on companies' success. Well, because following these shifts, companies have adopted two diverging strategies in terms of DI communication, either by retreating from any DI-related discourse. For instance, General Motors last year removed their entire DI section from their latest annual report. On the other hand, some companies also reinforced their position towards DI. Costco, for instance, now they are clearly communicating on the usefulness of DI language to reach their business success strategy. Therefore, the landscape is fragmented. Corporate responses are uniform. Firms are going into different ways. But what about people? What about investor reaction? And based on prior literature, we observed that investors tend to value DEI. There is a study that was made in 2024 by Brice Cotran, where he finds that after the announcement of the Stop Woke Act, a legislative text to restrict the use of DEI language in Florida in the domain of education and workplace, well, after the announcement of such an act, he observed that Floridian-based company lost 2% in the stock market, meaning that investors value DEI while making their decisions. However, the society, the landscape, is becoming increasingly polarized. As a recent example, you can see the image here. We can take the recent example of the American Eagle Great Jeans campaign and the advertisement that responded to this campaign, the Gap Better in Denim. Where we can say that both advertisements differentiate substantially in terms of inclusivity approach. One which is very, let's say, conservative, and the other one which is more related to the woke movement. But although they contrast both in terms of inclusivity, they were both successful financially and in engaging with their customers. And therefore, these tensions that are occurring right now highlight the need to reposition inclusivity in terms of theory, but also in terms of economic impact. And in this paper, we are motivated to do so by first using this list provided by the New York Times. Because this list, as I said, is holistic. It encompasses different aspects of what inclusive language can be. And currently, the literature, there is a lack of holistic approach. Also, the example that I told you about, well, there are responses to external factors. There are responses to exogenous shocks. And in the literature, there is no evidence yet of the direct impact of inclusive language on a firm's success, on a firm's ability to raise capital. And we're also particularly interested to look at how does this impact could vary given the international context. Will the impact evolve depending on the culture, the sector, or the people that are operating in the context of the company. And that's why we apply this research to the cryptocurrency sector, and more especially in initial coin offerings. Okay. Well, what's particularly interesting about ICOs is that, like I said, they are decentralized, and therefore their scope is international. They can occur in barely every part of the world. Also, well, there is an absence of disclosure requirement and a high level of information asymmetry on the ICO market. In fact, the only document available about the ICO is called an ICO white paper, which is unstandardized, meaning that, well, in the white papers, entrepreneurs can craft the information as they see fit. Okay, so therefore, with this setting, we can enjoy a large variety of inclusive language. We can benefit from a large variety of inclusive language across the different white papers. And also, last but not least, there was a study made by Fish and his friends where they find that actually 31% of investors fully process the white paper while making their decisions, while only 3% do not read it at all. Therefore, white paper matters, okay? Now, if you would like to go to the toilets or to grab a cup of coffee, I will directly go to my main findings. So, this paper is about estimating the economic impact of inclusive language in the ICO white papers on ventures' ability to raise capital. And we first find this effect being positive. Secondly, we find this effect being more pronounced when the ICO founding and, let's say, managing team is diverse in terms of gender and ethnicity. And lastly, we look at how does the context shapes this relationship, and we find the impact of inclusive language being more pronounced when the ICO country is left-oriented in terms of politics, when it is English-speaking, and when the industry is considered as non-controversial. Yeah?
When you say inclusive language, you mean gender-wise, age-wise, race-wise?
So I explained just before, is the impact of this list. Wait, so the impact of the list published by the New York Times, so it encompasses different aspects of inclusivity. Yeah, so let's continue. So in terms of theoretical background, in this paper we argue that inclusive language leads to higher funding by signaling startup legitimacy. And based on that, ICOs would align with inclusive language to align with investors' norms and values, therefore gaining external support from them. What literature finds? Well, inclusive language is associated with better information flow, but also higher feelings of innovation, self-belonging, well-being. Therefore, inclusive language, by triggering these feelings, can lead to attract a broader pool of people, a broader pool of investors. And well, also we can say that when when entrepreneurs and investors are aligned, well, investment relationships are likely to last stronger. And in entrepreneurial finance, there is only few evidence of the impact of inclusive language in fundraising success. There is a study made by Gorbataille and Nelson where they find that women-oriented communication leads to fundraising success. But however, like I told you just before, we depart from such study by using a measure which is more holistic, that encompasses different aspects of inclusive language. And next, our second hypothesis is that we argue that inclusive language is more effective when it is backed up with DEI commitment, or in other words, by hiring, building, and managing a diverse team. Managing such team can provide to investors a signal of quality, because it would be difficult to replicate for low-quality companies. Because by reaching out to and communicating, managing different people from different backgrounds, well, you have to work on with some conflicts that could occur, and therefore managing such teams can induce some costs. And therefore, in this paper, we expect the impact of inclusive language being more pronounced when the ICO team is diverse. Let's move on to the research design. So, with our research team, with Sebastian, which will present right after me, we went through different ICO aggregator websites to collect ICO-related data, as well as the corresponding white papers. And finally, we built one of the largest databases on ICO that exists right now, with 1,202 ICOs that occurred between 2015 and 2021. Regarding our variable measurement, we used the logarithm of the dollar amount raised as a proxy for the ICO success. Our inclusivity metric is the count of the words issued from the list in each white paper. And our measure of diversity in the team, called Div Index, well, basically we take the mean of the gender and ethnic diversity of the ICO team. We also selected a set of comprehensive control variables related to ICO design features, such as on how many social media is the ICO present, also financing variable like whether the ICO accepts fiat currencies as means of payment, and other textual features like the readability of the white paper. And for remaining biases, we select year, quarter, region, and industry fixed effects. So now, testing hypothesis 1, we regress the amount raised on the inclusivity and the control variables. You can observe here in model 1 that we find a positive and significant effect of inclusivity on the ICO amount raised. However, we were also interested to look at the effect of high levels of inclusivity in the white papers, and that's why we included also in model 2 the squared term of inclusivity. And what we observe in model 2 is that this squared term is negatively significant, suggesting that inclusive language leads to fundraising success, serves as a tool to increase the fundraising success until a certain point, suggesting a curvilinear relationship here. In other words, economically speaking, one standard deviation increase in inclusivity is associated with 18% increase in the funding. Or one inclusive term, in terms of monetary amount, is translated to $140,000. Here you can see briefly the curvilinear relationship that we find, and we find an optimal set of 37 words in each white paper, therefore recommending to entrepreneurs that based on our research, this would be the optimal amount of inclusivity that you could include in your communication here. Now let's move on to see the moderation effect of the ICO team diversity. So remember the diversity index that I told you about. So what we did, we took the median score of this index and we split the sample in two based on this median score to distinguish the effect of inclusive language when the ICO team is low, when the ICO team diversity is low, or when it is high. And what you can observe here, we only find a positive and significant effect when the div index is high, suggesting that beyond the symbolic message that it conveys, inclusive language can lead to higher fundraising only when it is backed up with DI commitment. In other words, ICOs should what we call walk the talk here. And we also did a Z-test to ensure the statistical dependency of our Boson sample. Pretty interesting, right? So this is in line with what we expected. So next, now that we have answered our two hypotheses, we were also particularly interested to know whether the legitimacy signal of inclusive language could vary across the context in which the ICO operates. So by enjoying this setting of ICO, which is decentralized and occurring worldwide, we argue that the positive and legitimacy effect of inclusive language is more pronounced when the ICO aligns with the contextual norms in terms of sector, language, values, and so on. And so based on prior literature, we identified three potential moderators shaping this relationship. We first argue that the positive impact of inclusive language is more effective in left-leaning countries, because prior literature finds that DEI values are more in line with progressive countries, and there are also other evidence of, for instance, bright individuals are likely to be against the adoption of gender-neutral terms in their countries. So therefore, we expect this impact to be more effective in such countries. Next, we argue that inclusive language is stronger in English-speaking countries. Why? Well, because in such countries like in Anglo-American culture and countries, CSR and DEI disclosure are more institutionalized. And therefore, investors are likely to react more to such type of discourse in these countries. And lastly, we argue that the effectiveness of inclusive language is reduced in controversial industries called SIN. What are SIN industries? Well, they are industries related to porn, gambling, tobacco, and drugs. Well, why they would react less? Well, first, literature finds that overall investors tend to react less to such type of industries, given the signal that they could confer. But also, well, the values conveyed in such type of industry, they might differ substantially from the one conveyed through DEI. therefore suggesting a mismatch between investors' values and the values present in this industry. And also, let's say that DEI words in such type of setting can signal something weird. They might work as obfuscating tools to convince investors to invest in the project. So what we did here, we just took the main model than before, and we make inclusivity interact with each moderator to verify our assumptions. So left orientation for the politics, suggesting whether the ICO country is left-oriented, is the degree of left orientation in each ICO country. In the English variable and the scene industry. And what we find in the table here, you can see the three panels on the table, and we find in panel 1, panel A and panel B, a positive and significant interaction term of inclusivity and left orientation and the English variable. In line with our assumption, we find that inclusive language indeed leads to higher fundraising when the ICO country is left-oriented and English-speaking. But also in panel C, we find that a negative and significant interaction term between the inclusivity variable and the scene industries, in line with what we first thought. So this confirms our assumption, but also it provides evidence of the importance of the ICO context. So to take it highlights the importance to take the international feature of ICO while doing this result, because, well, this relationship could vary depending on the context in which they occur. So, just to finish, this relationship may be driven by unobservable variables, which would be hardly quantifiable and observable, leading to endogeneity concerns. And to alleviate such concerns, we employ two approaches here. First, a restricted control function. So, just in simple words, what we did is that we first modeled the probability of a white paper being highly inclusive, and we regress that probability on the set of covariates in our model. From that regression, we computed and extracted the generalized residuals that we incorporated in the main model. Why? To proxy for omitted variables, but also to test the robustness of the causal effect of inclusivity on the ICO amount raise. But furthermore, we were also particularly interested to proxy to account for investor characteristics that could be correlated to diversity, equity, and inclusion, like gender, sexual orientation, disability status, or religion. So what we did the survey, an online experiment, where we crafted different versions of a white paper that was varying in terms of inclusivity. And so the investor, what they had to do, okay, I have to read the white paper, I have to decide how much I will fund the project with, and also estimate the willingness to invest in the project. So we collected this type of data, but also their characteristics, like I told you just before. So here you can observe the results. So overall, we find our results being similar to what we found before. In panel A, we include the generalized residuals as a control, the gen-res here in panel A, and we find the effect of inclusivity being still positive and significant. So, and in panel B, we include the investor's control collected through the experiment, and we find a positive and significant impact of inclusivity on participant investor decision and on their willingness to invest in the project. Therefore, this suggests that our results are robust to at least endogeneity code through omitted variables. So, to conclude this paper, in this study, we look at the impact of inclusive language on economic success of a company in light of the recent societal and political shifts that are occurring right now. We contribute by positioning inclusivity in terms of theory, but also in terms of economic impact. Impact which is positive, non-linear, and shaped by DI commitment and the ICO context. And overall, in this paper, we can provide valuable recommendations to entrepreneurs to craft the white paper in a way that they can communicate effectively with investors. Which is a challenge right now because the ICO market, like I said, has boomed once again very recently and is characterized by a high level of information asymmetry. Therefore, it's very important for them to know how to master their disclosure. So this presentation has come to an end. Thank you for listening. Well, beyond DI, beyond good practice, DI is also good business. So I hope I convinced you, well, because you were all included in it. Thank you. Questions? Gabriel?
Yeah, I have one question related to this kind of boomerang effect of this inverted U-shape.
Can you repeat?
Yeah, I have one question related to this boomerang effect of the inverted U-shape that you showed. So the quadratic effect that we saw, it was, yes, it was significant and it was negative, but are you going to be able to really see a global negative effect of the, let's say, the inclusivity of the success of the ICO or not? I mean, what is the point from which you start to have a detrimental effect?
So I showed you in the slide. So do you mean do we have an optimal?
No, not the optimal. So for every unit that you increase in the liquidity index, then you have this quadratic effect, which means that the growth, instead of being exponentially growing, it grows.
You want me to look at the marginal effect then?
Yeah, at which point you start having these losses or.
So far, I do not know. That might be a good question.
Because you show this U shape,
Yeah,
but I'm not sure if you really find out the point from
where it starts to.
this is truly detrimental. Because what the effect, the positive effect was 0.053, the negative was 0.001, which means that your ratio or your utility value needs to be very, very high. You know, to be detrimental.
Yeah, so do your results change if you scale the mentions of those diversity words by the number of words in the ICO? Because you come with the magic 37, right? But I'm guessing that 37 is different whether you have 100-word ICO or whether 1,000-word ICO. So it might be worth looking to see if there's a scale.
So, as a robustness check, we divided the number of inclusive words by the total number in the white paper. We find similar evidence. I haven't checked the curve linear relationship, but we still find positive and significant impact. So, as a robustness, it was in it's in the paper actually.
So, is there a section of ICO of white papers that is typically the section where they include inclusive words? So when they, because I'm assuming the tokenomics section there's not too much scope for inclusivity or exclusivity. So I imagine that there's some section where your inclusive word count is coming from, and I'm wondering if it's possible that what your results are picking up is actually the size of that section. So the inclusive, the number of inclusive words is just acting as a proxy for how much time the white paper spends explaining whatever that section explains, like the philosophy or something.
So regarding this section, that's a really good question. What we did, so often the white paper starts with a description of the project and so on, and start and finishes with the ICO team and token distribution, I would say. But most of all, the ICO team. What I did is that I split this white paper. So I look at the result where the results were changing based on so I cut the white paper in 4 different points based on the number of words, and I look at whether there were more inclusivity at the beginning, in the middle, or in the end of the white paper. We found no significant evidence of the impact. So from that point, that was a bit sad in my research because I wanted to include it. What also I was thinking about, I told Gabriel this morning, is to be closer from that, is to maybe capture the context in which the inclusive words are written, in which they are expressed, because it's Thank you.
May I start? So, hello everyone. I'm Sébastien Wilmet. I'm a PhD student at Catholic University of Louvain in Belgium. And today I'm very excited to present my research paper titled How Circular Economy Drive Token Investments. I'm working with James Tewison, José Poirier-Lisquet de Montfort, and Yves de Ronget, all also from UC Louvain in Belgium. So before getting into details, I would like to present the main results and the main objective of this research. So the main objective is to investigate if circular economy, circularity, influences investor decision making in the context of initial coin offerings. I find this paper particularly interesting because, contrary to prior literature, here we focus on circular economy and fundraising, something which was never done before. We have four key findings, which are that more than 54% of our sample use circular-related language. We found that short-loop circular economy language leads to higher funding. Thirdly, that circularity boosts quality and innovation. And finally, that country factors tend to moderate our results. So let me define what is circular economy, circularity. There exists plenty of definitions for circular economy, but here we focus on the 10R framework. And with the 10R framework, in simple terms, it's about keeping products and material in use for as long as possible. So with the 10R frameworks, we start with a short loop, where the product remains the closest from their original function, with refusing, rethinking, and reducing resource use. After that, we have the medium loop, where the product keeps much of their original function, with, for example, reusing, repairing, refurbishing, and so on. And finally, we have the long loop, where the product is the farthest from their original function. As they are totally destroyed and transformed in something new with recycling and recovering. As a concrete example, think about IKEA. They are reusing hubs for second-hand furniture. They spare parts to repair products, and they recycle materials. And all that in a goal to be fully circular by 2030. The context and the motivation behind this research is that, and we all know, we face a climate emergency. And so, since this climate emergency, few sustainability frameworks arise, like ESG and circular economy. For the first one, it exists plenty of evidence in the literature for the link between ESG and investor decision making. But for circular economy, it's not the case, and more especially if we focus on startups. So for that reason, we want to focus on the circular economy communication in startups, and it's linked with fundraising. So in that goal, we review the literature, and we focus on the circular economy literature. And we saw that most of the studies focus on large and established firms, and few studies put in evidence that circular economy can affect profitability, valuation, and valuation. However, because these firms are very large, they face rigid processes and path dependency, and so they are less inclined to be circular. So here we want to operate a shift coming from large established firms to startup like ICOs, and introduce a new kind of companies, native circular companies. So basically, companies that are circular since their start. So by focusing on ICOs, we looked at what makes their success, and we saw that the white paper matters for the success of ICOs, especially the clarity and the content of these ICOs. However, there is no evidence of the importance of circular economy language in such ICOs. So based on this literature, we articulate different hypotheses. Firstly, we articulate that if ICO white papers with higher level of circularity communication are more likely to achieve either short-term or long-term financial success. And after that, based on the 10R frameworks and the different loops, we articulate three alternative hypotheses that are that ICO white papers emphasizing short loop circularity strategy or medium loop circularity strategies or long loop circularity strategies are more likely to achieve financial success. To answer to these different hypotheses, we relied on a dataset of 1,200 ICOs from 2015 and to 2021, and we did a keyword analysis, a textual analysis, based on a dictionary based on the 10R framework. For this dictionary, we compiled more than 43,000 of words related to circular economy language. And based on that, we were able to create 4 different key predictors, which are firstly the 10R variable for the aggregated 10R score, and after that, a score for the short loop, the medium loop, and the third loop, the long loop. Here we are testing 2 different outcomes for financial success. For the short term, we are testing the funding amount, and for the long-term financial success, we are testing the 1-year cumulative abnormal return. So here are the different regression models that we are testing in this study. And for each of them, we did a set of control variables grounded by established literature. So now I'm presenting the main result for this study. As you can see by looking from model 1 to model 4, we can see that circularity variables has a positive and significant impact on the amount raised, more especially the 10R, the short loop, and the long loop. And if we focus more deeply, we can see that it's a short loop that leads to this financial success. So for that reason, we focused on the short loop, and we also tested the robustness towards endogeneity for this short loop. And by doing 3 different tests, we see that this result remains significant and positive. Now for the long-term financial success, we did the same analysis. However, we don't find any significant link. So it means that circular economy communications matters for short-term financial success, but not for long-term financial success. Now that we have found this link, we want to know what drives this relationship. So for that goal, we looked in prior literature for 3 potential mechanisms that could explain this relationship, which are firstly, one increase in the quality of the ICO. Secondly, one increase in the innovation of the ICO white paper. And thirdly, in the attention of retail and institutional investors. To proxy quality, we are using a variable that aggregates the ICO ratings from external experts. For innovation, we did the topic modeling where we compute the proportion of technical terms present in the ICO white paper. And for attention, we are looking if the ICO is backed by crypto funds for institutional investors. And for retail investor attention, we are looking at the level of activity on Bitcoin Talk. To test this different mechanism, we are doing a 2-stage method. In the first stage, we are testing the impact of the circularity variable on the different mediators. And in the second stage, we are adding the different mediators in the main regressions. So now I'm presenting the result for the different mechanism, and by starting for quality. Here we see that short loop has a positive and significant impact on the quality, and if we add the quality proxy, this one has a positive and significant link on the amount raised. Similarly, if we look at the innovation mechanism, we see that short loop has also a positive and significant link on the proxy for innovation, and at its turn, the innovation proxy has a positive and significant link on the amount raise. However, if we look at the attention mechanism, we see that for both proxy, circularity doesn't have any significant impact. So it means that we found what drives the relationship between circularity and the amount raised is the quality of the ICO and the innovation of the white papers of these ICOs. Finally, now that we have found what drives this relationship, we are curious at what could shape this relationship. And for that reason, and because ICOs are occurring worldwide, we look at different country characteristics that could moderate our results. And so here are the different characteristics that we are testing, which are the quality of institution, the environmental score, if the ICO is in a country already engaged in a circular economy strategy. For all these different characteristics, we expect that investors will react less to circular economy communication as they are more used to such language and see it as a standard, so react less to such communication. So now I'm presenting the different results for the different interaction. And as in line as we expected, we find a significant and negative relationship between the different proxy for institution, environmental score, and circular economy strategy. So it means that in a country with higher quality of institution, in a country with higher environmental score, and in a country already engaged in a circular economy strategy, investors will react less to circular economy communication. So to conclude this presentation, we were curious about to know if circularity influences investor decision making in the context of ICO. And for that, we can answer that yes, circularity matters because we found a positive and significant link. And more especially if we focus on the short loop CE language. We see that it's information quality and innovation that drive this relationship, and also that institutional context shapes investor interpretation. So now, if you have any question, don't hesitate to ask me, and I'm looking forward to chat with you in the farewell doing afterwards. Thank you for your answer. Long term also is a but because I think because ICO are especially more resource consuming, that short loop with reducing, for example, it can be a reason that if we directly in the ICO white paper we said that we will reduce the energy for the ICO, that it could be a good reason for that, for example. I don't know if I'm clear.
When you were presenting, I was thank you so much. When you were presenting, I was thinking possibly it's wrong direction. Can it be related that possibly all these circular economy terms are still kind of buzzwords? They don't bring anything tangible. I mean, in ICOs.
Yes, it's difficult to say for that. No, I couldn't answer, but yes, it's difficult to say for that one.
Thank you very much. Okay. Um, Hello, everybody again. Thank you. Thank you for coming. And my name is Roman Matkowski, and I'm coming from Rennes School of Business from France. And I work with amazing co-authors, amazing friends. Ilva Beckerstrom from King's College London, and we started working with her like 3 years ago or something, and Akanksha Jalan from the same university as I am. It's been 7 years plus that we collaborate in research. So this presentation is about memory influence, or just memory, how what we remember, or another way around, how what we do not remember affects our expectations, affects our beliefs about something. We have many young US students, right? Possibly it's not very close to you, but some time ago I started noticing that I do not remember as good as I remembered when I was your age. And misremembering something actually affected me in terms of expectation what could come next. So it happened several years ago, and it actually was the root for this research. So, some general outline. We used cryptos as the sandbox because it has amazing characteristics. It's very volatile. It doesn't have fundamentals and all these things that we are speaking about. And individual investors, they are not experienced. They do not. They are not knowledgeable. They are overconfident. They are men. So at the same time, trading in cryptos increases, both from institutions and from households, from individuals. So for instance, retail investors, it's about 40% of daily trading crypto volume. So if we compare it to stock market, we have only 23% there. Of course, it's because it's easier to trade in cryptos, it's gamified, I would say, and also it attracts a lot of young investors. So, as I said, cryptos are also lacking these fundamentals that typically we use for the traditional financial markets. Financial literature actually highlighted that memory distortion move inflation and equity beliefs. But what is going on about cryptos? It was, well, at least I didn't find any paper on this. And we have here a high volatility, plus minus 10%. It's not rare, and we have quite naive answers that can be amplified in any direction. So then we looked into the literature. So we have that heuristics like recollecting of the past events influence investment decisions in different directions. It actually conflicts with the decision making made by rational models. On the other hand, we also have publications that people use memory recollections to form expectations, to form economic expectations as well, and also to reconstruct events and simulate future outcomes. So we have some publications that memory and people evaluation to record experiences. So it's kind of adjusts their future price expectations in terms of traditional financial markets. We also have that past experiences actually shapes people economy decision in general. We have that associative memory shapes both beliefs and decision in traditional financial markets. So yes, it has some effect. But what about cryptos? Again, something new, something quite unregulated, quite that we cannot explain sometimes how it behaves. So, do faulty memories of past prices or future expectations? That was the main questions we had in mind. Again, it's still in work in progress. So, any comments would be highly appreciated. There are several theories about memory, and actually it was hard to choose one theory. But typically it's good to have one paper, one theory, and we stick to the Tulving theory. Tulving suggests that there are two types of memory. There is episodic memory and semantic memory. So episodic memory is actually recollecting of specific events. It can be related, for instance, to numeric recall of past prices or price crashes or some significant events in the market. And we have semantic memory that mainly refers to more general knowledge about the world, about the financial markets, about crypto markets. And semantic memory errors would more likely be gaps in knowledge. And we tested, yes, typically investors are not knowledgeable what they do. They are confident, but they are not knowledgeable. So, in associative memory theory, recall prices can serve as an anchor. So expectations can be drifted left, right, given of what they remember. That is the general framework. So, the main results. Episodic memory errors about past crypto prices are significant, are huge to be honest. They also vary per gender. So, these errors systematically dampen bullish price expectations. So, the higher errors, the less optimistic about the prices. We have that richer semantic knowledge. They actually offset this negative effect. So those who have better knowledge, they were more optimistic. And we created inflation expectation index, and it is positively linear related to crypto price optimism. So we could basically say that people see it as an inflation hedge tool. So now let's go deeper into the data and into.
So what do you mean by three item inflation expectations index? What do you mean by three item inflation expectations?
Expectations about future, expectations about bills, expectations about grocery prices, and the general macroeconomic situation in the country. So based on these three, we created
an inflation index.
Yeah,
right?
kind of inflation index. We checked with alpha. Yeah, it was okay to use. So data. We had 850 individual investors, not investors. We launched a survey in 2024 in April in France. So it's purely French data. Age from 16 to 65, mean age 43 years, and 52% of women. We wanted to look more at these gender potential gaps. So again, it was randomized questionnaire, attention check, and then to measure the errors, you need to have some reference point, right? So we asked, so the field work was done in a couple of days. So we asked the respondents to recall the price exactly 1 year ago. So we averaged to, let's say, to the middle of the month, 1 year ago. So it was, what was the price in April 2023? And then to get this error, we went to Yahoo Finance, and we just average per month the price, and then we just subtract what we see, what they guessed, and we had the error. So raw error per coins. We use several coins, so we asked respondents to recall prices for Bitcoin, for Ether, and for Solana, the main ones. So we calculated the absolute, or raw error as the difference between recall and the average price 1 year ago. Then we calculated relative error, errors divided by the price in April, and we just then went to the aggregate relative error index when we just sum up all of them across all the cryptos. So the main variables. So we had recall prices for Bitcoin, Ether, and Bitcoin and Ether. Solana was excluded later. We had the raw errors recalled minus actual. Again, relative that I mentioned. Then we calculate also absolute values of the errors. It was standardized. Then we had general memory crypto error index. That is the average of all of them. And then we use cognitive and familiarity measures based on financial literacy or general semantic memory based on the quiz. And then we use the self-reported familiarity with Bitcoin. And then we asked about several questions per crypto, different familiarities in terms of I traded, I own it, I sold, I wanted to invest it, I read about this, so different parts. And then we just created a specific semantic memory index, familiarity with both cryptos, Bitcoin, Ether, with either of them, only with Bitcoin, or not familiar at all. So then we use standard demographic variables. So education level, relationship status, employment status, gender, and age. Age was regrouped to several brackets. So then we had expectations and sentiments. So expectations for crypto price trends. So it will decrease dramatically, decrease significantly, stay the same, increase. And then we created for robustness check just the binary variable. It will increase or not increase. And similarly we did for the grocery expectations. So prices will increase, decrease, or stay the same. So then experience with crypto investments. We control for gains and losses. Quite interestingly, that those investors who had losses were more into continue getting. Those who had losses, they said they are more willing to continue staying in the market. Those who had gains, they actually wanted to exit.
So excuse me, all this is part of the survey?
Yes, the same survey. And yes, frequency of crypto trading. Because if you trade more, potentially you remember better. Or that was the thought behind. So here is the first preliminary result. This is the episodic recall. And here in the table you see the errors for males and the females. So the difference between the fact and the recall. And you see that is tremendous. So Bitcoin mean error is 203% of variation. Median is minus 24%. Ethereum error is 181%. And females, they looks like they are just guessing. It was the impression. Here we have the distribution, the densities of the of memory crypto absolute error by gender, and there's so far one interesting pattern that male typically undershoots the price and the female typically overshoot the guess. Yeah, I don't know why. So then I applied to myself. If I have cryptos, possibly I remember better. So we have the memory errors and crypto ownership. 0, no current crypto ownership. 1, yes, I have cryptos now. Truth, higher memory errors are associated with lack of crypto ownership. Then again, gains versus losses. So possibly if I lost, I would start paying much more attention to this next time. So what we have? 0, no reply. 1, gain it. 2, lost. So those people who lost, they typically do not remember well. Possibly it's the mechanism. And 3, I don't want to say that it's just a tiny fraction. So then we look at the trading frequency. So 1 is several times per day, 2 is once per day, and 7 comes to several times per year, and the 8th we didn't have an answer, so once per year no one traded. And we see that the errors peaked for several times per day. It's not logical, it's not rational actually. If I trade more, I remember it. But it means that individual investors mainly guess, mainly trade for fun. They are not far from professionals.
Also going back to 1 year ago, is too long a memory, right?
Yeah.
Because especially for this type of market that's very volatile. So either you go back to say 3 months ago or like some, this is arbitrary for sure.
Yeah, yeah.
Or you take account of the volatility somehow in order to find some volatility adjusted index or something like that.
Yeah, sure. Thank you for this. Yeah, we have the draft with the volatility. Yeah. So in terms of 3 months, yeah, it's a good idea, and we were restricted in the number of questions, and we couldn't keep both, so we just went for the longer term. And also, the inspiration came from the working paper published on Anberg about memory. Weber, Michael Weber with Korodnichenko, they use 1 year. But 1 year, yeah. But for stocks and groceries, it's okay. But for cryptos, yeah, that's very right. We try to adjust with the volatility. Results similar, pretty much. So again, the question was about investment strategy. Is it short-term investment or long-term investment? So 1, short-term, 2, long-term. For short-term, for speculation, the errors are high. Actually, it makes sense. So then we looked at the semantic memory, general understanding, general knowledge, what they know. So we have ages, and this lighter is a female, and this darker, we try to escape the stereotypes in terms of colors, relate to men. Obviously that general crypto knowledge higher for youngers and for male young individual investors. Here we have the self-assessed crypto familiarity. Again, by age group and female and males. So gray means not familiar at all. So this is huge. This is the majority. Blue means familiar only with Bitcoin. Green is familiar with Ethereum also, only, and this yellowish, reddish is with both coins. So again, the older, the less familiarity, and typically, yeah, they are. It's a bit tricky because, for instance, we see the different proportions, but still, we have the majority knowing both of them. And yeah, females are less familiar.
This might show more confidence rather than familiarity, because true familiarity. Because the question was the question: are you familiar with Bitcoin or not?
It was one of the questions. Other questions were familiarity was based on the I had cryptos in the past, I have cryptos now, I will have cryptos in 3 months, I will have cryptos in 12 months. So then we move to the price expectations, and yeah, the majority honestly answered don't know. But most of the respondents are actually bullish about crypto. So they expect that price will go up in a year. So here we have the crypto price expectations, again, by age, per gender. The difference is statistically significant between the estimates, and quite interestingly that so young female are quite pessimistic. Well, the oldest we didn't expect much, but about young females it was quite. So they are more pessimistic than men at the same age. And yeah, and of course, no answers dominate across respondents of different ages. So then the main models. We ran a lot of them because there were several issues. The main issue was the number of the respondents, because when you filter all the respondents by the crypto owners, not crypto owners, then by gender, then by expectations, so the numbers were decreasing. So again, different variations of the logistic regressions. Then we play with elastic net to have more robust. Then propensity score was applied. Then the idea was that people typically guess. They are clueless, but they don't want to look clueless, right? So we use Latin class models and Heckman selection model. Actually, these types of models first classifies into guesses versus the ones who know, who really knows. And yeah, then e-values we applied to estimate what if we have some variables not included, would they offset the results or not? Then we place with causal forests for heterogeneous effects to have some overall treatment effects, some kind of proxy to causality, and then Bayesian mediation moderation analysis. It was additionally.
Excuse me, what are you trying to model here? The probability of what? In a logistic regression. Probability.
Yes, higher than mean, lower than mean. Errors. The errors. The dependent variables errors. Memory errors. So
larger errors versus smaller errors.
Yes.
The probability of making an error, a larger error.
The probability of making a larger error.
Larger.
Well, we did different ways. So we did when we just modeled the errors, transformed. Yeah, general regression. And then, yeah, I forgot to put, and then as the robustness, it was higher than the median or lower than the median for errors. With the continuous variables, it wasn't very convincing due to a number of observations, to be honest. And the variability of the errors from plus 1,000 to minus several hundreds, even after transformation, it didn't look convincing. So it was one of the ways. So yeah, here there is the methodology in more details, but yeah, it's just nothing sophisticated, just standard tools that we use. Okay, so the main results. The good thing is the results are consistent across different models. So what we have that yeah, one standard deviation increase in Bitcoin memory errors cuts the odds of expecting price to rise by 77%. Yeah, roughly. Then we did for the elastic net, so we had the same coefficient. So Bitcoin errors negative, yeah, Ethereum errors are positive, but they were not significant always. Then from the propensity score, after each high error, responder is matched to look alike in terms of age and gender. High errors still halves the chances of being bullish in a year. Then we use the weighted PSM. So again, we have similar results. It's still negative. Yeah, Heckman Latin class estimation when we separated recallers from guessers. So we have 41% roughly of recallers and 59% roughly of the honest honest guessers who are clueless about the prices. So we still have the same sign. For the e-value sensitivity, yeah, all the unmeasured confounder would need to be 3.6 times more strongly linked to both memory errors and optimism than actually measured covariates to wipe up the effect. So yeah, we assume that it's quite hard to have this. And yeah, causal forest also high memory errors lowers the probability of optimism by roughly 10%. So then we try to look into the mechanism through which channels it might go, and possibly it's because of inflational expectation, possibly it's something else that can help us to explain this. So we created the inflation expectation index. So it's average 12-month outlook for petrol, groceries, and utilities. Yeah, we apply contrast alpha, and yeah, so it's meaningful covariates in the end. They support vector machine classifier was applied when bullish equals to 1. So yeah, what we have that when we rank by importance, so familiarity with both coins, then BTC absolute errors, and then inflation index. These are the main three factors that affect being bullish in next 12 months. Then again, we try to play possibly with knowledge and other covariates, and we found that knowledge boosts confidence. So even little knowledge boosts confidence significantly. So we have the moderate misrecall undermines it, to be honest. So high inflation expectation nudge optimism. So yeah, they potentially see it as an inflation hedge. Then we play with the moderated mediation through the fifth regression. Yes, and we had that memory errors cut optimism only a small part of this, roughly 6%. Walks through dependent inflation sentiments. Yeah, and again, we did some conditional mediation and knowledge again transmit more of this. So the main takeaways. So memory biases shape crypto price expectations, even in the highly volatile market like cryptos without fundamentals. So what investors remember typically and what they know about cryptos and what they fear about the macro prices together, they actually affects their beliefs. And yeah, correcting episodic anchors plus bolstering crypto literacy potentially can stabilize the market, because if it relates to whole individual investors, or we can generalize that potentially it can have effect, it contributes negatively to the volatility, or positively to volatility, negatively to stability of the market. And that's it. Thank you so much. Questions?
So did you create your inflation index from the survey?
Yes.
And what was the logic to do it from the survey, using the survey instead of just using an inflation expectation index for funds?
It's a good point. Well, the first idea was to stick to the same data source. Since they are the same investors, potentially, yeah. But yeah, it's a good point to check with the.
Yeah, well, because when you mentioned that in the beginning, I thought your idea is to see to measure inflation expectations from their perspective, and especially from the fact that petrol prices are important for more younger investors investing in crypto market. I don't know. Yeah, that's. I was thinking about it while you were.
We have it. We have it.
Yeah, but then, yeah.
We have inflation expectations per unit, per counterpart, groceries, petrol, utility. We have aggregate. We have per gender, per age, per asset. So if you own some specific asset, what do you believe about inflation? So, but yeah, it's not included into this. Yeah, we tried to draft the full paper on expectations and asset adoption, because we have 12 assets.
In any case, you might want to check the robustness of your results.
Exactly.
Use a standard inflation expectation index and then.
Thank you. It's just completely the slip of our mind.
Thank you.
Thank you. Other questions? Yes.
What do you think will happen with the legitimacy of cryptocurrency? Like, how will countries recognize it? Because it's not as recognizable as the stock market is. And because of that, there are more fluctuations there. There's a lot more probability of scams, like coins that are created specifically for pumping down strategies. Do you think that more coins will emerge, like Bitcoin or Ethereum, that will become stabilize it, that will be more trusted, that investors will transport, so that the price will not fluctuate as much?
Oh, thank you for the question. If I knew the answer, I probably wouldn't be here. I would be somewhere on the island under the coconut palm tree. I believe in Bitcoin itself. It's the first successful experiment, and so far the whole industry is created around it, with all the types of the instruments traded. Ethereum, it's very expensive, so possibly it will be replaced with something cheaper, but given the scope of the usage of Ethereum, I think it will stay around. About new coins, we have more than 22,000 in circulation of different ones. So you can come home and to create one token overnight, right? So it will be creating constantly, but probably if we find the way to solve the trilemma, and once we create this famous coin that will satisfy all the three requirements, it will be a new milestone in the crypto market. It will be volatile because everyone sees things in different way. For someone, fundamentals is technology. For someone, the fundamental value is the ease of transfer from one country to another. Yes, so it depends on all of us, and how we agree on using cryptos as a mean of exchange or store. Well, we already agreed on Bitcoin as store value. So then, but scam always happen. We are human beings, and we are very creative in doing bad things with the same tool. Did I answer the question? Yeah.
And then thinking like strategies like we used to in the past with the gold standard, like when banks used to have gold collecting in order to back up their coins. Something similar along with those.
I have several friends from central banks, and they typically tell me that they dream to wake up one morning and there is no cryptos. They don't know what to do with this, but it stays around because of us. So yeah, this is my answer. Trump tries to do the national reserve through crypto, through Bitcoin, but what will happen after Trump, I don't know. And now Kazakhstan tries to do similar, as far as I remember. Other countries try to keep in mind to create something similar, but it should be mutual agreement. And how it will be integrated into monetary system, I have no idea. El Salvador experience showed that IMF is not ready for using it as a. Thank you. Thank you so much then. See you.
Hi guys, welcome. This is the best part. We're gonna have some very interesting announcements. One, that the conference will be fully financed by the Greek government forever. Second, Larissa decided that the conference will be in Greece for the next 20 years, and she picked 20 Greek islands, so you stay here for a long time. And third, Larissa told me that she has big dreams about this excellent team of researchers in order to make collaboration with the Greek commissioners, the bankers, and make the crypto as the major currency in Greece. So I want you all to thank Larissa. Let's give a big applause. Because it is so nice dreaming, you know. And I want you to thank you all for these 2 wonderful days in University of Athens. It was a great honor for me to have all these colleagues coming all over the world and discussing about the real thing, which is the research that you do in your universities, in your excellent research teams. And I hope that this will continue, because again, my belief is that the transformation of the economies to a digital era is very close, and all we need your assistance and guidance. Once more, thank you, Larissa. Thank you, Stathis, for your help. I would like to thank Dr. Dimitris Kenourios on behalf of the University of Athens for his assistance as well, and the chair of Department of Economics, my lovely colleague George Dotsis, for being here with us today, and all of you. And now I would like to give the floor to Larissa and see what really needs to announce, and I will be so glad to hear your announcements. Larissa.
One second. May I start first of all to say big thank you for the whole team of National Kapastisian University of Athens for hosting cryptocurrency research conference this year. I think you can all agree it was super hot. We all enjoyed the venue, everything went really, really smoothly, and we really, really appreciate your help. Thank you very much, Aristasis, of course, and Vice Director of the university, and to all the colleagues who helped, who contributed, who chaired the sessions. Many thanks to all the delegates. I really hope you enjoyed it. I have some good and bad news. Let me start with bad news, probably, that you might already heard, that tomorrow taxi drivers are going on strike. So if you haven't heard this yet and you're traveling tomorrow, please ask hotel reception, or we'll try to find some alternative ways how to get to the airport. Yeah, this is quite a bad news. I'm very sorry about it, outside of our control. Yeah. Yeah, even better. Also, even better, even much worse news that also buses going on strike, bus drivers and metro. So there is basically no public transport and no taxis. So for who traveling tomorrow, yeah, we are trying to look in on details what can be done. The immediate advice to speak with the hotel reception, because typically they have in a contact of some drivers, so they can help to arrange. Also recommending to talk to each other during the drinks, who travel in what time. Maybe we can kind of group together and, you know, share the rights and things like that. Yeah, so let's address this issue collegially. Yeah, work together, talk to each other, and help each other and give each other lift if it would be needed, all right? Yeah.
So taxis are on strike from 6 a.m. onwards. So if you are traveling at 8, let's say, go at 5 a.m. If you're traveling at 12, go 5 a.m. The metro is on strike, but it will work from 9 a.m. to 5 p.m. So you can take the metro. However, judging from past experience, it will be super crowded because nothing else will work. So give yourself plenty of time. My suggestion, talk to your hotel. They might be able to arrange a car or something for you.
My suggestion is stay in Greece.
Stay in Greece.
This is great. Yeah, so that's it with bad news. Actually, from now on, just good news, all right? So, just I think it was important piece of information in case you missed it, and yeah, just so you can start planning it in advance. Okay, so let me first announce where we're going to be next year, because we selected our next host, and I think location will surprise many of you, because it's very unusual for cryptocurrency research conference to go outside of Europe, and we will go outside of Europe next year. We're going to Latin America, and we're going to Chile. So, and may I also point to host of the next year conference, Hugo Benedetti. So I know you know Hugo already. He was presenting here. Yeah, so if you have any ideas for the next year event, please reach out to us, and let's make next one also very special. September, yeah, probably mid-September, so 1 week earlier than this time. Yeah, so this is a big announcement. And now I think the most anticipated part, so we'll announce best paper awards. Yeah, let me explain the process. So what we did, we selected, members of organizing committee selected 3 papers as a strong contenders for Best Paper Award, 3 papers for Best PhD Student, and we sent it to John Goodell, who is Editor-in-Chief of Research International Business and Finance, and he picked up the winner. Yeah, so please don't shoot us if you're disappointed. He considered lots of different factors, but one of the factors is, of course, paper should align somewhat with the scope of rebuff. So if your paper is out of scope completely of Research International Business and Finance, it would not be selected. If there are certain conflict of interest, if you are my best friend co-author and we publish 20 papers together, you unlikely will be selected as well, because it will imply to certain conflicts of interest. He will not pick this paper even if it's quite strong, so considerations like that. But nevertheless, I'm really proud to announce first winner for Best PhD Student Paper Award. And the prize of 1,000 United States dollars from Research International Business and Finance goes to Michael Wolfson for the paper title, The Learning Curve on Cryptocurrency Prices, Volatility and Eventual Adoption. Please, Michael, come here. Let's take a picture. Thank you very much. Let's take a quick photo and we send it to John. Thank you very much. I think those who attended Michael's presentation, and those who saw his paper, I think probably will agree that it's very strong piece of work, and it's very well-deserved prize. And I think now the most weighted and very competitive again this year for who will win the best paper award. And yeah, da-da-da. The prize of $1,000 from Research International Business and Finance goes to Francois Vasselin for the paper Segmenting the Crypto Asset Market, a Structural Supply-Demand Framework and International Finance Implications. Many congratulations, Francois. Excellent paper. Excellent paper. Thank you. Very well deserved. I think this is probably all good news for today, apart from that we're now all going for to have some drinks and very beautiful location, and we'll walk all together, so we'll have a little tour. So I really hope that you will enjoy the rest of the conference. And yeah, Aris, please.
One more announcement. Dimitri, come with me, please. We'd like to give some small memorial gift to Larissa for organizing all these lovely conferences, and especially in Athens. It was a great honor for us. And for that reason, we'd love to give you a pen to write. Come this way. This is a pen from University of Athens. In order to have your research written properly with a good roller pen. That's for me and
Thank you very much.
Also, something small, which is to put your business cards.
Ooh.
And remember University of Athens.
Thank you very much.
Thank you so much for
Thank
everything.
you so much. Very kind. Thank you very much.
Stay here.
Yeah.
Thank you.
Thank you very much.
And now I think we can have a little walk. We have to check the weather though, because it started raining 5 minutes ago. On the way to Plaka, we can walk all together and visit the Museum of Athens University by the Acropolis Hill, and check out the main buildings there, the area. Then you may have your cocktail, and you're going to have a small tour to the history of the university, and then it's free time for you to go around. Thank you once more. Thank you very much.